Hello everyone, this is Dr. Leela. Today I'll be discussing on preference share capital. Please do subscribe my channel. Preference shares. When capital is raised through issue of preference share, we call it as preference share capital. Preference shares, they carry preferential rights in regard to the payment of dividend and repayment of capital in the event of winding up of the company. Let me explain in detail. Companies, those desire of mobilizing large savings from the public, they have to tap all types of investors, including cautious and less venturesome people. Preference shares, it is a method of inducing cautious investors, and these securities, they provide dividend in preference to the equity shareholders. That is, preference shares, they carry certain priority rights in regard to the payment of dividend and return of capital. Preference shares, they are also called as hybrid securities because they have the features of bonds as well as equity shares. Let us see the similarity of preference shares with equity and debentures. Firstly, the similarity of preference shares and equity shares. Preference dividend are payable only after tax profit, and payment of dividend will depend on the discretion of board of directors, and irredeemable preference shares are long term in nature, that is, they don't have maturity date like equity shares. Secondly, the similarity of preference shares with debentures. Preference shares, it carries fixed rate of dividend like debentures. It has prior claim on assets like debenture capital. Preference shares does not have voting rights. Preference shares is redeemable in nature if the company is issuing redeemable preference shares, and preference shares does not have right to share residual profits or assets. Features of preference shares: claim on assets, claim on income, accumulation of dividend, redeemable, fixed rate of dividend, convertible, participation in surplus profit, and voting rights. Let me explain in detail. The first one is claim on assets. Claim on assets means preference shares, they have prior claim on assets of the company in the event of liquidation. And the second one is claim on income. Preference shares, they not only have prior claim on assets at the time of liquidation, but they also have the prior claim on income or profit. Preference share capital is called as senior security because it lies between debenture capital and equity capital with regard to the claim of an asset and income of the company. And the third one is accumulation of dividend. Accumulation of dividend here means dividend is cumulative, that is, all unpaid or arrears are carried forward for the next year and it is paid with the current year dividend, that is, before payment of any dividend to the equity shareholders. Redeemable. Redeemable means preference share capital has limited maturity period, and after that share capital has to be refunded. And then fifth one is fixed rate of dividend. Preference shares are issued at a fixed rate of dividend, and this rate sometimes may be lower than the equity shareholders dividend, but this helps the company to maximize equity shareholders wealth. Sixth one, convertible. Convertible. Preference share capital has the feature of conversion of preference shareholders investment into fully or partly equity shares at a predetermined ratio. In our economy, we have convertible and cumulative preference shares, but no company has issued preference shares. Next one is participation in surplus profit. Surplus profit here means the profit that is left over after paying dividend to the equity shareholders. Preference shareholders has the preference to participate in the surplus profit and surplus asset at the time of liquidation. And the last one is voting rights. Generally, preference shareholders, they do not have voting rights, but they acquired this right when dividend falls in arrears for a number of years. Types of preferences. We have 8 types of preferences: cumulative preferences, non-cumulative preferences, redeemable preferences, irredeemable preferences, participatory preferences, non-participatory preferences, convertible preferences, and non-convertible preferences. Let me explain in detail what does all this mean. Here, cumulative preferences. Cumulative preferences means under cumulative preferences, the unpaid dividend is carried forward as arrears and it becomes the charge on profits of subsequent years, and this go on accumulating till they are paid off fully out of the available profits of the subsequent years. Non-cumulative preferences. Non-cumulative preferences means these preference shareholders, they do not enjoy any right over the arrears of the dividend, and therefore the unpaid dividend in arrears cannot be claimed in future. Third one is redeemable preferences. Redeemable preferences means these shares are repaid at the end of the given period and it is paid back to the shareholders out of the profits or out of the proceeds of new issue of shares. And the maximum redemption period is 20 years, and these redeemable preferences, they are similar to the debentures, and it is to be noted that only fully paid preference shares are redeemed. Irredeemable preference shares. Here these shares, they continue as long as the company continues and they are repaid only at the end of the lifetime of the company or on winding up of the company only. And the next one is participatory preference shares. Participatory preference shares means these are the shareholders, they enjoy dividend 2 times. First time they get their nominal fixed rate of dividend as per their entitlement, and also they participate again along with the equity shareholders in the distribution of profits. Non-participatory preferences. Non-participatory preferences means they are entitled for the dividend only the fixed preferential dividend. Convertible preference shares. Convertible preference shares means these are the preference shareholders, they have the option to convert them into equity shares within a certain period. Non-convertible preference shares means these are the shares which are to be redeemed or refunded at the expiry of the fixed period. Advantages of preference shares. Company point of view, it is discussed both under the company point of view as well as the investor point of view. Company point of view, it provides long-term capital for the company, and a company can raise finance for a long term without creating any charge over its assets. And the second one is no legal obligation to pay preference dividend. And the third one is no share in control of the company because they don't have any voting rights. Preference share capital, it is treated as part of net worth and this enhances its credit worthiness. When we talk about the investor point of view, they get fixed rate of dividend, they have preferential claim on assets, and it is less risk when compared to the equity. Disadvantages of preference shares. This is also discussed under the company point of view and also the investor point of view. Company point of view, the disadvantage is, first one is tax disadvantage. Tax disadvantage means preference dividend is not tax deductible, and this makes preference share capital as a costly source of finance. And the second one is adverse effect of credit worthiness. Adverse effect of credit worthiness means if the company avoids payment of dividend regularly, then it has adverse effect on credit worthiness. Permanent burden of payment of dividend in the event of inadequacy of profits. And investor point of view, it has limited returns. Limited returns as preference shareholders, they do not have voting rights, and the return, that is dividend, will depend on the managerial decisions, and preference shareholders, they cannot force the management to pay more and more dividend to the preference shareholders. And the second one is rate of dividend is less than the rate of dividend on equity shares. And the third one is market prices fluctuates more when we compare with the debentures. Thank you.